In today's video, we will look at a simple but effective three-step price action strategy. So without wasting any time, let's get started. Price action trading means making trading decisions by observing historical price movements without using any indicators. For this, we use candlesticks, support and resistance, chart patterns, and trend lines. So today's video will be purely based on price action, where we'll use a three-step process. Mostly what beginner traders do is take trades randomly anywhere, and then they face losses. So this three-step process will definitely help you take a profitable trade. So what are those three steps? Let's see. Step 1. Identification. If the market is in a downtrend, we have to look for selling opportunities. If the market is in an uptrend, we need to look for buying opportunities. According to this strategy, we should avoid sideways markets. Once we do the trend identification, we mark key levels like support, resistance, demand, and supply. How do we mark these levels? Simply by marking the most recent swing level that was broken. So according to this structure, this is the level. Now we check whether the level we marked has been tested previously. So yes, this recently marked swing level worked before once as resistance, then later as support. So this completes step 1. We identified the trend and key level. Step 2. Prediction. Now we predict what can happen next. Only two things can happen. Either the price will go up or down. According to the downtrend, we predict that if the price comes to this level, it may go down from there. In this step, we simply ask ourselves, suppose price comes up and stays in this zone, then we try to predict what may happen next. It's a very simple step, but believe me, this can save you from many losing trades. So we have done trend identification and prediction, that if price reaches this level and then drops, we'll look to sell. Step 3. Take action and enter. Here, we will use multiple price action elements, like candlestick patterns, chart patterns, trend lines, etc. How do we do this? On the lower time frame than the one we used in steps 1 and 2, we use chart patterns or trend line breaks with some candlestick knowledge. Chart patterns like double top, triple top, head and shoulders, double bottom, and many more. Now, when we take trades using this three-step process, we never trade randomly. We trade based on a system and price action. Most beginners make the mistake of trading randomly. They feel they must trade daily. But it's better to trade one good setup with discipline than to trade randomly every day. So unless you get a clear trade setup according to your strategy, don't take the trade. Now let's look at some examples. Here's the first chart. First of all, we do trend identification. This level worked multiple times as resistance and support. So based on the trend and structure, we assume the price may drop if it comes to this level. But that's not confirmed yet. Now we switch to a lower time frame and wait for the price to approach this level. This is the same level we marked on the higher time frame. Now the price approaches this level and forms a double top pattern, which is a bearish pattern. Plus we have the resistance level acting as confirmation. Price failed to break this level twice. According to the double top pattern, if the price breaks the neckline, we'll enter a sell trade. Next example. The market is in an uptrend, so we look for buying opportunities, but not randomly. We use the previous swing that was recently broken and draw a zone based on that. Now we check if this zone has been tested before. Yes, it worked once as resistance. So during the uptrend, we marked a zone and will now wait for price to come to this level in the lower time frame. Then we can trade based on chart pattern or trend line break. Now, as the price reaches this level, we get a head and shoulders pattern. This is the head, and these are the two shoulders. How do we trade this pattern? Simply, when the neckline is broken, we can buy based on candle closing. Next example. On the higher time frame, the market is in a downtrend. We mark the structure level and switch to a lower time frame. Now the price approaches this level. On the higher time frame, we saw a downtrend, but this short-term trend is up. So we wait for this short-term uptrend to end. If you observe closely, we can draw a trend line. If this trend line breaks, it means the short-term uptrend is ending and the market may go down from here. Again, on the higher time frame, the market is in uptrend. We draw a structure level based on the previous swing break, which has been tested multiple times. Now we switch to a lower time frame. We wait for price to reach this level. As the price approaches this level, we see a double bottom pattern. When price breaks the neckline of this pattern, we can enter the trade. So this is how you can use chart patterns and multiple time frames to trade based purely on price action. Hopefully, you got some useful information from this video. If you found the video helpful, don't forget to like and subscribe to the channel. See you in the next video.